When headlines announce geopolitical conflict and stock tickers bleed red, retail investors often liquidate their portfolios in a panic. Institutional asset managers look for a specific mathematical signal instead. They use the copper-to-gold ratio to track the balance between industrial expansion and capital preservation, identifying the historical extremes that often precede a market recovery. Methodical. Today, we are going to learn that system. I will show you how to calculate the copper-to-gold ratio, interpret its signals regarding global economic health, and execute a physical rebalancing of your portfolio to capture the recovery rally. To follow along, you will need two things. Open a financial charting platform in one tab and log into your active brokerage account in another. By completing these steps, you replace emotional guesswork with a quantifiable advantage. You position your capital to grow exactly when the majority of the market is paralyzed by fear. Step 1 is building the indicator. Go to your charting platform, find the spot price of copper per pound, and divide it by the spot price of gold per ounce. This division gives you a single decimal ratio. This formula works because these two metals represent opposite economic forces. Copper demand rises through manufacturing and construction, making it a proxy for industrial growth. Gold demand rises during instability, making it a proxy for safe haven fear. A rising ratio means growth is outperforming fear. A falling ratio means fear is taking over. Now, plot this ratio on a monthly chart and apply a 14-period Relative Strength Index, or RSI, to help gauge momentum. This chart shows the historical copper-to-gold ratio. During normal economic cycles, it bounces safely between a floor of 0.15 and a ceiling of 0.70. Looking at April 2026 data, the ratio has collapsed. It broke the historical floor, hitting a 50-year low of 0.00078.
For context, during the global financial crisis in 2008, the ratio bottomed at 0.00110. During the peak lockdowns of the 2020 pandemic, it hit 0.00084. The 2026 reading is deeper than both. When you see a reading this extreme, the instinct is to sell everything. Do the opposite. Historically, this level of terminal fear stabilizes and turns weeks before the S&P 500 reaches its absolute lowest point. It signals that a massive equity rally is imminent. Before committing capital, we must verify that this ratio extreme is driven by geopolitical panic, rather than a genuine collapse in U.S. industrial health. We need a real economy check. Pull up the U.S. ISM Manufacturing PMI for March 2026. While headlines focus on the Iran conflict, the PMI registers at 52.7. Any number above 50 indicates economic expansion. Manufacturers are actively increasing production. We also look at the new structural demands for copper. The build-out of artificial intelligence data centers requires immense power distribution and cooling systems. Hyperscalers are projected to demand over 572,000 tons of copper annually, and they buy regardless of high interest rates. Additionally, the transition to electric vehicles requires 80 to 85 kilograms of copper per car, compared to just 20 to 25 kilograms for internal combustion engines. This permanently shifts copper demand away from traditional housing cycles. While demand is rigid, the supply side is heavily constrained. Global refined copper deficits are projected to exceed 300,000 tons over the next year due to slow mine development and regional instability. We have peak geopolitical fear driving gold up, combined with undeniable industrial expansion and a copper shortage. The market's panic is disconnected from the reality of production. This creates our buying zone. Step 3 is execution. Go to your active brokerage tab and open your order dashboard. First, harvest for gains from the fear trade. Trim or sell your safe haven positions in gold, as well as the energy sectors that spiked artificially on the initial war news. We sell these because of the oil shock paradox. When oil prices surge past $120 a barrel, inflation expectations rise. This forces the Federal Reserve to keep interest rates high, which creates a direct headwind for a non-yielding asset like gold. Take that harvested capital and reallocate it into broad S&P 500 composites. Specifically, target the technology and growth stock sectors. Morningstar data indicates that the recent volatility has pushed the technology sector to a 23% discount relative to its fair value. You are buying high-quality assets during a rare oversold window. Finally, execute a buy order for copper exposure. You can use copper futures or allocate capital into copper mining ETFs. During 2025, precious metals saw massive gains while copper lagged. Given the structural supply deficits and resilient demand we verified earlier, copper is severely undervalued compared to gold and is poised for a catch-up rally towards $6.50 per pound. You have now moved capital out of overbought, fear-driven assets and secured discounted industrial assets. When the broader market realizes the economic engine is still running, you are positioned for maximum upside. Your portfolio rotation is complete. You successfully locked in profits at the top of a geopolitical spike and bought into growth equities at a deep discount. The copper-to-gold ratio allowed you to filter out the noise of the news cycle. You diagnosed the true risk appetite of the market using cold, hard numbers. Over the coming weeks, monitor the S&P 500 to gold ratio. It is currently compressed near 1.38. When you see this specific metric stabilize and begin to rise, it provides secondary confirmation that the global risk-on phase has fully resumed. Systematic, data-driven execution outperforms emotional trading. If you want to keep building your analytical edge, hit subscribe, and I will see you in the next breakdown.